Hello, I'm Professor Keister. Welcome to another discussion on corporate and partnership accounting. Tonight we're going to talk about two concepts. The domestic production activities deduction, which is of course a deduction, and the alternative minimum tax. Now, just as a brief refresher, in Chapter 1 we discussed the various forms of business that are affected by tax law. Individuals, partnerships, I should say sole proprietorships, partnerships, and corporations. We also spoke in Chapter 2 about the differences between individual and corporate taxation and the subtle nuances and differences. Now, that's going to kind of play a role in Chapter 3. The domestic production activities deduction is obviously a deduction, and both individuals and corporations that are involved in qualified production activities may avail themselves of the deduction. Now, you may ask, well, gee, Professor Keister, why are you just saying individuals and corporations? Why aren't you also including partnerships? Well, if you'll remember going back to one of the first videos where we talked about forms of business, partnerships and sole proprietorships are pass-through entities. Those business entities do not pay taxes. C corporations do. S corporations that elect to be treated like a corporation do. But S corporations that elect to be treated as a partnership, all forms of partnership, including limited liability companies, and sole proprietorships are all considered pass-through entities. They do not pay taxes. The individual owners or partners pay taxes, and they pay those taxes on the individual 1040 forms, which they submit every year, or hopefully they're submitting every year. The domestic production activities deduction is a very unique deduction. To my knowledge, it's the only deduction that is not associated with an expenditure, an expense, or other outlay. A dividend received deduction might qualify, to tell you the truth, but I don't think so. But I absolutely know for a fact that the domestic production activities deduction is not, unlike most other deductions, is not based on some kind of an outlay, some kind of an expense, some kind of an expenditure. Rather, the domestic production activities deduction is based on income that certain activities generate. That income is known as the qualified production activities income. More about that in a minute. Let's go back to the concept of the domestic production activities deduction. Essentially, and by the way, the DPAD, moving forward, I'm going to call the deduction DPAD. It's less of a mouthful. The DPAD is applicable to both individuals and corporations. You tend to encounter it more often, though, with corporations, and the reason why is it's a manufacturing related or associated deduction. Okay, you have to be involved in some kind of domestic manufacturing, domestic production, and we'll talk about the various forms of production that qualify. In order to manufacture goods or grow food or whatever, it usually takes a fair amount of capital. So you tend, and corporations can raise capital more readily than partnerships or sole proprietorships. Now, why is that? Well, sole proprietorships and partnerships don't have a whole lot of options when they want to raise capital. They either have to, the owners have to either reach into their own pockets and contribute, or in the case of a partnership, admit a new partner who brings in contributed capital, or they have to go to a bank. Now, if they go to a bank, that whole concept of unlimited liability, and especially where partnerships are concerned, mutual agency, remember we talked about this in a preceding video, that rears its head again. Bank loan officers do not like high-risk ventures, okay? They do not like borrowers, or they do not like lending money to borrowers who are at high risk. And certainly sole proprietorships and general partnerships, very high risk, remember? Unlimited liability. And then, of course, as you go through the range of partnerships, the liability kind of dials down until you finally get to the level at the LLC where you're kind of on par with the corporation. But certainly, also proprietorships and general partnerships, banks are kind of leery to loan money to. Now, they will loan money to banks, to sole proprietorships and partnerships, but it's at a higher interest rate, and the restrictions tend to be harsher. The loan agreement tends to be more restrictive, I should say. Corporations, on the other hand, find it much more easy. It's much more easier for a corporation to raise capital, additional capital. True, they can go to the bank, but they have a couple of other avenues or opportunities at their disposal. They can raise money through issuing stock, through an initial public offering. Now, that's not something you do overnight. I get that. You have to do a whole lot of research. What's the par value? How much of the stock are you going to own? How much are you going to issue? And then, of course, you have to go through some kind of entity that will manage and handle all that, the contracting of which has to be very detailed. And the same is true with the bond issuance. A corporation can issue a bond issuance as a way of raising money. Now, the problem with the bond issuance is that the same thing with the stock. You've got to sit down and you have to figure out, well, what's the coupon rate that I'm going to offer? What's the going rate for a corporation of my size? What's the risk? What's the coupon rate, meaning to say the interest that we're going to offer on the bond? What's the term to maturity? Are we going to be are we going to be paying our interest annually, semi-annually, quarterly? So these are all the things that you have to take into consideration. And again, you're going to need another external agent to handle the floating of the bond, to handle the listing. And then again, once again, you've got the legal aspect of dotting all your I's and crossing your T's. This isn't an inexpensive proposition, but looking at the numbers, you might decide, hey, it's cheaper for us in the long run to have a bond issuance or an initial public offering rather than go to the bank and pay the high interest rate that the bank wants. So, but again, that's why you tend to see domestic production activities deductions associated with corporations, because they can generally raise the capital that's needed for manufacturing. Okay. What kind of manufacturing are we talking about here? What really qualifies as domestic production activity deduction, or for the domestic production activity deduction? Any kind of manufacturing. See, manufacturing, construction, engineering, architectural work. Let's see, architectural work. Small. Food production, and here's actually a really interesting one. Film production and sound recording, meaning say music, and then the generation of power, natural gas, or potable water. Now, in the cases of power, gas, and water, we're talking about the production, not the transportation to the end user. Going back to the DPAD now, you're probably wondering, okay, well, how do you calculate this deduction? It's actually fairly simple. Domestic production activities deduction is limited to 9% of the lesser of qualified production activities income, or, if you're an individual, adjusted gross income. If you're a corporation, taxable income before net operating loss and dividends received deduction. Okay? So what's qualified production activity income? Those are the revenues that are derived from your domestic operations. Let's say you're an international corporation and you had, throughout the entire of last year, you had $1,000 revenue, and $700 of that came from domestic receipts. Okay, your qualified production activities income would be $700. Now, how do you calculate that? Well, really, the qualified production activities income is domestic production gross receipts less your domestic cost of goods sold and your domestic period costs. So you look at the receipts in total, you separate them into domestic and non-domestic. Then you take a look at your costs. You take a look at your cost of goods sold, which are known as your production costs. You take a look at your period costs. You separate them into domestic and non-domestic. Then you take the domestic portion of your gross receipts, your domestic production gross receipts. You take your domestic portion of your cost of goods. You subtract from that your domestic portion of your cost of goods sold and the domestic portion of your period costs. And voila, you have qualified production activities income. Oh, there is a limiting factor here. I almost forgot. Your deduction, your domestic production activities deduction, DPAD deduction, is limited. As I said before, it's 9% of the lesser of QPAI, or in the case of an individual, AGI, or in the case of a corporation, taxable income before NOL and dividends received. But it's subject to a cap, and that cap is 50% of your domestic W-2 wages. Okay? All right, so let's talk about domestic production gross receipts. As I said, those are the receipts, the revenues from all your domestic sales. Okay? DPGR are the revenues derived from the lease, rental, sales, or exchange, transfer, or other disposition of qualified production property that was manufactured, produced, grown, or extracted in the United States or substantially in the United States. I think the rule of thumb is, if you have a product and you look at the total cost of goods sold, and more than 20% of the cost of goods sold were incurred in the United States, then you can consider that whole thing as qualified production property. You don't have to break it out, is what I'm saying. Now, so we're talking about manufacturing of trucks, automobiles, building houses, okay, assuming you're a developer, not if you're building a house for yourself. Films largely created in the United States. As I mentioned earlier, electricity, natural gas, and potable water production. By the way, where natural gas is concerned, beware, we're talking about natural gas, not methane gas from a landfill. That does not qualify as for DPGR. Engineering and architectural projects. Any receipts you derive from engineering and architectural projects and assignments, for projects and assignments that are going to occur here in the United States, and those qualify as DPGR, meaning say revenues or receipts for domestic production. One thing you want to I want to talk about is some retail sales associated with production don't qualify as domestic production gross receipts. Let's say I've got a vineyard, okay, And on that vineyard, of course, I grew grapes, and I convert the grapes into wine. And I bottle the wine, and I sell it to CVS and Harris Teeter, things like that. But let's say I've got a little wine tasting room where people out for a day in the country can drop by and sample some wine, maybe buy a bottle or two. Unless the gross receipts from that retail operation are less than 5% of my total gross receipts, I cannot include it. I cannot include those receipts or consider those receipts as domestic production gross receipts. Let me rephrase it. Let's say, same scenario, last year I did $1,000 worth of retail sales of my wine plus sales from a little retail operation that I have on my premises. Okay, so I'm selling wine to merchandisers, but I'm also selling some wine on site. If more than 5% of that $1,000, if more than 5% of the revenues of that $1,000 came from the retail operation, selling in my store on my premises, I cannot include that as domestic production gross receipts. So let's say I've got $20 that I acquired or derived from operations in my store on my property. I could not include that $20 as domestic production gross receipts. I've got $980 in domestic production gross receipts. Now, if I were to sell less than 5%, which is what, $10. So if I was to sell, no, be helpful, Mike, if you could do math. That'd be less than $50. Okay, back up. My numbers were wrong, I apologize, but I think you get the idea. So again, I've sold $1,000. If 50 of that, I have $1,000 in gross receipts. If $50 or less of that came in the form, were derived from my retail sales, then I can consider that whole $1,000 as domestic production gross receipts. But if I had more than 5% or more than $50, so let's say $51, let's say $100, okay, so I had 10% that was in revenues derived from retail operations, I could not include any of that. So my DPGR would only be $900. So what is qualified production property? Well, qualified production property is tangible personal property. And tangible personal property is anything that you can pick up and walk away with. Literally anything. It can be computers in the office, it can be furniture, it can be wall art, light fixtures, tools, machinery that's small enough and portable enough to be walked away with. Just anything that's portable, basically. Software is considered qualified production property. Sound recordings, you can say music, CDs. Automobiles, trucks, tractors, books, food, it's a big one, food, clothing, and then machinery and equipment other than permanent structures. So pretty much anything. The chair that was produced down in North Carolina, the stereo system that was produced in New York, the CD of my favorite band, okay, that assuming that it's a domestic band, books that I bought at the bookstore. That might not be the right concept. Books that were published, I should say, in the United States. Food that was grown here in the United States. Clothing, okay, that was, I guess, the text that was converted from raw materials into a jacket or a vest or a tie or a sweater. Those are all qualified production property. Now, what's not qualified production property? Well, buildings, land, and structural components of buildings. Another gross receipts, we're talking about domestic production gross receipts. Let's just talk about gross receipts in general, not just the ones associated with production. The big pile of receipts from which domestic production gross receipts are extracted from is comprised of total sales less any sales returns and allowances. So really you're talking about net sales. Any revenues you've derived from services provided, and then any investment income such as dividends that you've received, interest that you received, royalties or annuities that you received. So you've got this big pile of gross receipts. And from that big pile of gross receipts, you have to sit there and figure out, okay, now which ones are associated with domestic production? As I mentioned earlier, to qualify as a domestic production gross receipt, the qualified production property must have been manufactured, produced, grown, or extracted in whole or in significant part, meaning to say more than 20% of its total cost of goods sold within the United States. QPP that was made out of salvage, scrap, or junk materials, as well as new or raw materials, qualify. Cultivating soil, raising livestock, fishing and mining materials all fall under manufactured, produced, grown, or extracted in the United States. Well, assuming that it occurred in the United States. I'm going to skip construction property. We already talked about electricity, natural gas, and potable water production. So that's really domestic production activities deduction. One of the things I do want to include, or do want to talk about, is the concept of embedded services. Let's say I manufacture refrigerators, and with each refrigerator, I include a 3-year warranty, and I sell that whole package for $1,000. Okay. That whole $1,000 is considered domestic production gross receipts. But let's say I sold the warranty separate. So let's say the warranty was $100. So that means the refrigerator really, I'm selling it for $900. Again, I get $1,000 from the consumer, and that's a receipt. But because the warranty is sold separately, it does not count as a domestic production gross receipt. So I only count $900 of that $1,000 as a domestic production gross receipt. Okay. Now we get to the really fun part of tonight's discussion. The alternative minimum tax. Going back to the beginning of tonight's discussion, I mentioned that there are two concepts that are common to both individuals and corporations. There are 3 deductions that both an individual and a corporation are entitled to. Now remember, the corporation is actually entitled to 9 deductions, but there are 3 that the corporation has in common with the individual: charitable contributions, net operating loss, and domestic production activities deduction. There's something else that individuals and corporations have in common. That's the alternative minimum tax. And this is one of these things that, government gives something a name, and it sounds all warm and fuzzy, but it's not. And when you think about it, it should really, really upset you. one of the reasons why I got into taxation was because I thought, hey, with the government as in dire need as it is today, for every tax penny it can acquire in order to pay for Obamacare and the social welfare programs, basically the $16 trillion that we're in debt, tax accountants are going to be in really high demand, and there is an element of truth in that. But I had also hoped to be able to use the knowledge and experience of being a tax accountant, not just in a professional capacity, but in my own personal life, with the intention of lowering my taxes as much as possible. And there is I hope it was made clear to you in some of your readings, tax avoidance is not against the law. Tax evasion is, but not avoidance. You are not breaking any law by applying every opportunity, every deduction, every exemption, every tax credit, every opportunity that the tax law affords you to reducing your tax burden, assuming that these are legitimate applications. Now, it's one thing to contrive a business transaction with the intent of reducing your tax burden. It's one thing to go about purposely incurring a capital loss or an operating loss in order to take that loss and reduce your tax burden. That's a no-no. But if you did, through legitimate business operations, end up with a loss, there's nothing wrong with taking the opportunities that the tax law offers the taxpayer to reduce your tax burden. I hate to say benefit by the laws, but to make something out of it. Okay? Sort of like making lemonade when life hands you lemons. Well, so much for wishful thinking. The alternative minimum tax came about back in the 80s, and these tended to be technology people, by the way. But back in the 80s, a lot of people who were making these incredible sums of money were retaining the services of six-figure tax accountants to come in and use every opportunity in the tax code to reduce their tax burden to the point where they were paying less taxes than someone who was living underneath an overpass. Okay, that's a bit of an exaggeration, but you get my point. And the government said, nix to that. Okay, now you're taking, it's one thing, and I kind of understand and sympathize with the government. It's one thing to offer the means by which someone can ease a burden. It's one thing to have that system turned around and used against you, okay? And that's what some of these people were doing with the tax law. They were using it against the IRS, and as a way, they were using it in a way that was thwarting the IRS's mission, which is, as we all know, to raise revenue. So the IRS, the federal government, the judiciary got together and said, that's wrong. And so the IRS issued something or implemented something called the alternative minimum tax. Now, what I'm getting at is, I could be the best tax preparer in the world. I could be the best tax accountant in the world. And let's say I've got an income of $100,000 and I get my taxable burden down to, let's say my taxable income down to, $100. And you think I'm kidding. There were people out in Silicon Valley that were getting pretty close to that. Okay. The government says, we want you, in addition to your very, very ingenious way of calculating taxable income, Mike, we want you to calculate your taxable income using this method. It's called the alternative minimum tax. And I can guarantee you're going to come up with a different tax burden. How it works is, let's say I come up with my taxable income, which is, say, $100, and using the IRS's alternative minimum tax, I come up with a taxable income of $1,000. Guess which taxable income is going to be used to compute my tax burden? The alternative minimum tax. Okay. It's a complex calculation, actually. I knew it at one time. And I can walk you through it here. But essentially, your alternative minimum tax is the individual or the corporation's taxable income before net operating loss deductions. Now, you have to add back to that certain adjustments and certain preference items. What you're trying to do is you're trying to get to the taxable income that the government thinks you should have. So we start as ground zero with the taxable income that the taxpayer has calculated that their tax should be based on. So we're not starting at income, we're starting at taxable income, okay? And then we add back to that certain adjustments, such as state, local, and property taxes. Any interest on mortgage loans that did not involve the purchase or improvement of a house. So like maybe you took out a home equity loan and you didn't use that. Let's say you used that to pay off your car or your credit cards. You got to add that interest back in. The net operating loss deduction, if you had deducted that from your taxable income. Depreciation on post-1986 property. I don't quite get that, but just write that down and remember it. And here's a curious thing. 10% of AGI on medical expenses. Apparently, one of the deductions you're entitled to as an individual is 7.5%. You're allowed to deduct medical expenses to the extent of 7.5% of your AGI. But for purposes of AMT, you're going to add back 10% of medical, was it 10%? Yeah, medical expenses to the extent of 10% of AGI, okay? So you're actually adding in more. So what they're doing, they're kind of padding a little bit to taxable income, your preference items, and this is quite an extensive list. Your preferences, now most of these were things that we took out when we ourselves were calculating our taxable income. It was like I said, now we got to put it back in to come to the government's notion of what our taxable income should be. So we're going to add back the tax-exempt interest that we received from, say, municipal bonds, I should say tax-free investments. Accumulated depreciation on real estate property in excess of straight-line depreciation. Percentage of depletion claimed in excess of property's basis. For insurance company, for integrated companies like Exxon, you need to add back the excess of intangible drilling costs over 10-year amortization period if in excess of 65% of net oil and gas income. Who comes up with these numbers? And insurance policy payouts on the death of key employees. Okay, so that brings you to the alternative minimum tax income. So I started off with the taxable income that I calculated. I added to it my adjustments and preferences, and that brings me to AMTI, alternative minimal taxable income. Now I've got a parenthetical that says plus or minus 75% of ACE minus AMTI. I have to look up what that reference is. I have no clue. But from AMTI, I now subtract my AMT exception. And that is going to be, the AMT exemption is going to be $40,000 minus 25% of the difference between AMTI and $150,000. That gives you your AMT base. Now, if that base is less than $175,000, you're going to multiply it by 0.26. If it's greater than $175,000, you're going to multiply it by 0.28. That's going to give you some number. Subtract, and I don't know what that number is called. You subtract from that any foreign credits you've received. That gives you your tentative AMT. Now, from the tentative AMT, you subtract the tax liability that you calculated based on the taxable income that you computed. And that gives you your alternative minimum tax. So that's the AMT. What I'm trying to get at, I'm not going to expect you to go through that calculation. I might give you some numbers and ask, okay, are you going to add this or subtract this? And, I might give you some fairly simple calculations, okay? But I am not going to ask you to memorize all of the exemptions, all of the preferences, all of the preferences and adjustments. I'm not going to expect you to memorize that stuff. What I do want you to understand is that the AMT is kind of a way of the beat cop saying, oh no, the speed limit's 35 miles an hour. Turning the car around and driving it in reverse at 50 miles an hour isn't going to get you out of a ticket, okay? Again, the government says it's not fair to the rest of the tax-paying community that certain individuals can reduce their tax burden as a result of their knowledge or expertise with the tax code. Now, frankly, I do have an issue with that. That's kind of like saying Secretariat, and actually, to tell you the truth, this is what they do in the racing community. I still think it's unfair because it doesn't reflect reality. But what they'll do with a favorite horse, they'll literally weigh it down with lead. They will put saddlebags on it and weigh that thing down with lead in order to level the playing field. Well, what the hell's the point of the race then? Okay, I've never understood that. But essentially what the government is saying is it's not fair to the rest of the community that some people who have the ability to hire tax experts or people who have developed an expert proficiency in tax preparation cannot benefit by it. That's wrong. That's sort of like saying, it's like going to like LeBron James and saying, you're 2 feet taller than or a foot taller than the average basketball player, so you got to play on your knees. It's a natural competitive advantage that he has, his height. It's like kind of saying you got to play in a trench. It just, to me, it makes no sense. But anyway, that is domestic production activities deduction and the alternative minimum tax in a nutshell. Thank you for watching.